We are excited to announce the expansion of the Tax Analysts Awards of Distinction, recognizing individuals and organizations whose work has had a significant and lasting impact on tax law, policy, administration, or public understanding. The next category, U.S. federal taxation, is live. We are currently accepting submissions to honor contributions of measurable impact in the federal tax field. The future of tax policy starts with bold ideas and bold leaders. Nominate now through January 30th. For more information, visit awards.taxanalysts.org. Again, that's awards.taxanalysts.org. Hello! From Lisbon, Portugal, this is Tax Notes Talk.
Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, looking for certainty. At the beginning of October, the podcast team traveled to Lisbon, Portugal for the International Fiscal Association's annual Congress. While there, we recorded several interviews, as well as some sounds of the city, which you heard at the beginning of the episode. We'll be releasing those interviews in the upcoming weeks, so keep an eye out for that in your podcast feed. This week's episode features Juan Manuel Vázquez, a lawyer at Loyens and Loeff and a researcher at the University of Amsterdam. Our conversation focuses on the shifting international tax landscape as the EU, US, and OECD attempt to implement the OECD's two pillars in a way that suits all parties. We also discuss the complicated task of taxing the digital economy, focusing on the rising importance of artificial intelligence and digital services taxes. One note before we get to the interview: since we had to leave the studio for this, the audio may sound a bit different than our usual interviews. All right, let's go to that interview. Juan Manuel, welcome to the podcast.
Hello, Dave. Thanks a lot for having me. It's a great pleasure to be here and share a chat with you.
So, to start off, why don't you tell listeners a little bit about yourself and what you do?
Sure. Well, I'm a tax lawyer originally from Argentina. So I worked mainly in law firms, also a bit in the public sector, in the tax authorities in Argentina. Lived a bit in the US doing my LLM at Georgetown and working in the US a bit. And then came back to Argentina. But soon after, went to Europe where I started my PhD at the University of Amsterdam. And 5 years ago already, I joined Loyens and Loeff in the Netherlands, where I work also next to my academic activities at the University of Amsterdam.
Well, it's great to have your perspective here. Could you tell us about what sort of recent developments in tax are you finding most challenging in your work?
Sure. I mean, we're living in really exciting times. In my role at Loyens and Loeff and also as a researcher, I really follow these developments on a day-to-day basis, and also not only trying to assess the impact that these developments may have on stakeholders, but also what are the red threads going behind them and the more substantive changes that these developments entail. So just to mention how I see the tax landscape from a European perspective. So we are in the middle of a really heated US-EU trade and tax conflict somehow. We've seen that these conflicts were mainly triggered by, of course, Pillar 2 UTPR and the tax profits rule, and the kickoff of that rule in 2026. In that context, I think we have a lot to talk about, of course, today, and this new side-by-side approach that the EU and the US, the G7 has somehow proposed and agreed, and that the EU is trying to accommodate. We also see in that context the discussion on Pillar 1 and digital services taxes being an important key element of these trade tensions. Next to those two big topics that I think are conditioning or somehow taking all the attention of the agenda at the EU level, most of the focus is on the European Commission intentions to make Europe a more competitive jurisdiction for businesses. So it's the EU competitiveness agenda that the EU Commission is pushing after the publication of the so-called Draghi and Letta reports, which have identified that the EU is lagging behind in terms of competitiveness, that there is a lot of red tape to cut, that there is a need for simplicity and a need for incentives for businesses and startups to invest in Europe, to stay in Europe and grow in Europe. So in that context, also on the broader EU competitiveness agenda, you see many proposals of the European Commission to declutter the tax system. For example, they are considering recasting the Angel proposal and pouring into tax 6 to kind of take out a bit the most burdensome elements of that proposal and making a watered down version with a reporting of information. Also, you see proposals to introduce 28th legal regime so that basically small companies do not have to comply with 27 different national tax regimes, but also that it's broader than taxation. This is an approach that goes beyond taxation, other legal fields too. Apart from that, we see recent initiatives from the European Commission to kind of boost the European financial market by promoting, for example, by a tax incentive, what's called the savings and investment accounts. So this is another big tendency, how to make Europe more competitive. But at the same time, we are in the middle of a change in geopolitical powers where many countries are investing heavily in military equipment. And so that implies, of course, raising new revenues to cover for those costs. So the EU is also, not only because of that, but because of repaying the debt assumed for the COVID-19 pandemic, having to think and design and adopt new EU-owned resources. So there was recently this discussion on the core contribution, that it would be a contribution at the corporate level across the EU, which is also a big elephant in the room whenever talking about EU law and what's happening in the EU. Sometimes it gets unnoticed. There was also this idea or expectation that the EU might propose an EU digital levy. Then it was somehow taken out of the table, but it is another element to say, okay, we want to raise more revenues. Also, we see like on the broader terms, a pushback from many member states in relation to all the initiatives that are coming from the European Commission, because mainly I think we had like the pendulum has been on an extreme where we've seen in the last few years proliferation of anti-abuse measures and adoption of directives in the field of direct taxation, which was not the case many years ago, where there were just a few. Now we've seen adoption in the last few years of many directives after the BEPS project to kind of curb the abuse, but now we see many member states pushing back to many of these proposals. The Angel is one example, but also we see some concerns raised in relation to BFIT, for example, to core. There are also proposals and discussions on wealth taxation that many member states are fighting back. So I think we're in a very interesting time where all these recent developments are somehow intertwined and they are really embedded into a broader context of political tensions and trade discussions. So it's very interesting times to do international taxation.
So you mentioned this two systems approach that's happening with Pillar 2 and the US, the agreement from the G7. In actuality, what is this this would seem to weaken the OECD consensus that had been reached. So how do you see that playing out?
Yes, indeed. I think first we should not ignore the fact that basically exempting the US from rules that have been globally agreed to ensure a 15% of effective tax rate along the globe, it really somehow undermines the whole underlying policy of the Pillar 2 project. And that's, I think, the big feeling around the world of many European countries also in relation to this side-by-side approach. The UTPR has somehow raised this problem, and of course this was something that was already existent when Pillar 2 was developed, because already there were great difference, even larger difference than those that exist today between the GLT and the Pillar 2, and mainly the difference between jurisdictional blending and global blending that still remains, let's say. So I think that this statement of the G7, coupled with, let's say, the failure of Pillar 1 as a global project and all the tensions that were somehow built up from the early days of the discussion on the digital economy until last year when we saw that there was no implementation of the Multilateral Convention on Amount Aid, those two kind of signs coming from the OECD, I think they weakened enormously the leadership position of the OECD, because basically on Pillar 1 we did not see an agreement, a success in the project, and in Pillar 2, which was the success case to kind of showcase to the world. Now we see a big exemption, a big carve-out for U.S. multinationals that I think politically will end up prevailing because, of course, of the strength of the U.S. as a player in global tax policy. But in the EU, there are, I think, tensions in relation to how to implement this at the EU level because, of course, we have an EU directive that has implemented the OECD Pillar 2 rules. And although there is an article there that allows somehow for safe harbors to be automatically adopted by any qualifying competent authority agreement reached at the OECD level, there are bigger discussions at the EU on whether indeed we should not amend the directive to allow for this type of exceptional treatment to the US. And then it comes the point of also how you will justify if you do not align this jurisdictional blending required by the EU directive and the global blending of income under the current version of the GILTI. If you do not overcome that, how are you going to also make the system coexist, right? I do think that there are technical ways of making the system coexist, but in general, the prevailing, let's say, position is that this has strongly undermined the Pillar 2 project in favor of one of the biggest players, that in this case is the US.
Do you see this as a possible beginning of Pillar 2 falling apart in the similar way as Pillar 1 didn't seem to meet the goals that it had set out?
I think it's a bit difficult question to answer because basically the EU has invested a lot in Pillar 2. They were one of the early adopters through the directive. There's been national implementation of the directive along the member states, guidance being issued, and a big sense of the rightness of adopting a minimum tax at the global level. So I think that at least from the EU perspective, it was not about ensuring that US multinationals pay a fair share of at least 15% ETR. It was really a global problem of saying, okay, we want to ensure, and if you remember, this proposal was pushed by Germany and France in the early days of the BEPS 2.0 project. So there was indeed, I think, like this general and truth intention of ensuring a minimal level of taxation beyond the US, right? But of course, like this setback or this situation in which we have ended with Pillar 2 might lead to, in the future, to reconsider the whole appropriateness of the project. I don't see that happening in the short or medium term. The European Commission and the authorities have been clear that they are not planning to repeal the directive nor disinvest everything that they've worked on in the last few years. And I think this is also something to reflect on because in the end, the fact that we've invested a lot also from practice, let's say, like the advice that European law firms and consultancy firms are giving on Pillar 2 is enormous, and it's giving a lot of work. But that doesn't mean that, if the policy is not appropriate and we see that the global landscape has changed and a measure that also is super complex, especially for developing countries to understand their impact. So, for example, now we're seeing cases of situations arising in certain big countries with high inflation rates where the Pillar 2 is leading to really unintended negative effects. And there are still new things coming out of Pillar 2 that are creating new problems. And at the EU level specifically, we see this big problem, legal problem, about basically the fact that the directive refers to the OECD as a source of interpretation and illustration. And in many cases, on the safe harbors, for example, it even kind of assigns the OECD, like it signs a blank check to the OECD to adopt these qualifying competent authority agreements without the need for an EU adoption under the procedures foreseen by the treaties. So basically anything that the OECD would say in Paris, even after the directive was adopted, and all the administrative guidance that came after the adoption of the directive, it's changing and expanding the scope and the limits of the rules. So at the EU level, that's basically giving away the democratic legitimacy required to adopt rules that are enforceable on EU taxpayers. So all these new problems that are coming from Pillar 2, I think that at some point, if they are not duly addressed, they will lead to strong questions to the initiative as a whole. And I think that would be in the end the defining element to say, okay, this is going to last in the long term because we have a complex system that it's with questionable legitimacy on many of the guidance and the rules, which now exempts the biggest player, the biggest country in terms of multinationals of the world. I think that this is like mounting reasons that lead one to question to what extent this in the long term is going to survive. But let's see. I think it's an interesting question.
So I guess that also leads to what I wonder about is for advising companies in this landscape of, Pillar 2 seem to be driving toward, at least, even though there's complexity, at least some sort of certainty. So in this new world where you have Pillar 2's future that is not certain anymore, a dual system going on, potentially some countries abandoning it and going in their own way, is there going to be additional complexity and uncertainty for companies going forward?
I think certainty, it's indeed one of the key words and requirements here, because we are in the middle of all these policy discussions and setbacks and backs and forth. Like in the end, there are companies, of course, that they are still having to comply with Pillar 2 and all these rules, right? And we see that policymakers are sometimes busy with for example, these developments on the side-by-side system and like how to make the rules coexistent with the U.S. Tax system. But in the meantime, there are so many practical questions that tax authorities have to deal with on a daily basis and in specific situations with clients, with companies, that cannot be solved by the tax authorities of the countries themselves, because they have to reach out first to the European Commission and then to the OECD, because it's a system that it is based on a common approach. So if you have divergent interpretations of the OECD model rules, then it becomes even more uncertain. So, and all these questions practical on the rules that will keep coming, they are next to these other big policy developments that are being prioritized by policymakers because they have the political spotlight, but are not necessarily addressed always. So I do see that there is a growing uncertainty for all these businesses that are already subject to the rules and are not certain about specific applications of the rules on how to solve this in the meantime that these global discussions on the side-by-side system are going on. So I think we have something there that is problematic for terms of legal certainty and the impact of the rules on stakeholders.
Support for this podcast is provided by Avalara. As a tax professional, you already know compliance isn't just about rates and returns, it's also about accuracy, efficiency, and protecting your business from unnecessary risk. That's why so many finance teams rely on Avalara. Avalara automates sales tax compliance end-to-end, real-time calculations, more seamless integrations with leading ERPs and accounting systems, and scheduled filing across thousands of jurisdictions. With dashboards and data designed for professionals who live and breathe tax, you stay in control with the information you need in a centralized platform. Free up your team's time, reduce audit exposure, and scale compliance with confidence. Visit Avalara.com to learn more. That's Avalara.com.
Turning to the other source of instability in the international tax system. So we had Pillar 1 that hasn't really lived up to its goals. But one of the main goals that Pillar 1 had was to tamp down this move toward digital services taxes. So are we seeing a resurgence of digital services taxes as the answer to reallocating income tax rights?
Yeah, I wouldn't call it resurgence, but yes, indeed, we are in a situation now in which the topic has become mainstream in the tax policy landscape, for sure. This somehow started because we had two moments like of let's say, popularity of digital service taxes, right? The first one was basically in 2018 when the EU came with this failed proposal to tax the digital business with a long-term measure based on significant economic presence and a short-term interim measure that was a EU digital service tax, taxing 3 types of services. After that first appearance of what we now understand as the kind of prototype of digital service taxes, many countries in the EU, France being the first, but then followed by Spain, Italy, we have also in the UK, Turkey, some countries in Africa started adopting digital service taxes. And in that first moment, the first Trump administration already tried to repeal that or tried to somehow counteract that reaction with several 301 investigations that were put on hold somehow with bilateral agreements with these countries that adopted digital service taxes, and also via the commitment reached at the inclusive framework level that put all the discussion on digital service taxes on hold, basically by saying, okay, we'll keep them until we reach an agreement on Pillar 1, and then if we reach an agreement on Pillar 1, we'll repeal these taxes and we'll credit the taxes for Amount A purposes, right? So at that moment, digital service taxes were not being discussed anymore in the global tax policy until 2024, last year, when we saw that this standstill and drawback commitment already, let's say, expired. And as of that point, we also see some key developments, like, for example, there was a French proposal to increase the tax rate of the French DST. Then there was the Italy elimination of the national threshold for DSTs. Then we saw some countries like Canada adopting a DST that they now rescinded due to US pressure. But we started seeing again like some movement there. Germany coming up with a proposal of a 10% digital service taxes. And then there was this kind of second moment of popularity of DSTs in which we still are. That again, the second Trump administration tried to somehow discourage countries from doing so, not only by the traditional investigations under Section 301, but also under the 899 proposal. So many countries also started changing their mind on DSTs. New Zealand, for example, I think it had proposed one and they decided not to move forward. Kenya had a DSTs and they changed it for a significant economic presence type of approach. Canada rescinded its own DST. So also we saw like, okay, there is something else going on also that affects this discussion of DST adoption. That is, of course, a renewed threats of tariffs imposition. And this was, again, the second moment was in the middle of a much expressed trade war somehow between the EU and the US that now has been somehow eased a bit through this agreement that we've reached. But that this does not affect, the agreement does not somehow cover future US retaliation to digital service taxes. So also, in the last few weeks, we've seen there's been a French Constitutional Court judgment validating the French DSTs, with, like, basically addressing all the typical arguments that are raised against DST, the discriminatory element, the fact that it's confiscatory that applies next to corporate income tax. So the French decision is really relevant because it will have an impact on the future of these taxes. And also we had a recent visit of the U.S. representatives to the UK, where it was questioned whether they were going to address the UK DST in this trade agreement, but in the end, the UK DST survived. So we see now that in the last few weeks, DSTs have somehow survived the US pressure, and the big question is how things are going to evolve, because although the European Commission has confirmed that they are not planning in the short term to propose an EU digital levy, the idea, at least in people working on this area, and I'm not speaking about people working in the European Commission indeed, but in the environment in the EU, this idea is being discussed. We held a conference at the University of Amsterdam actually recently where we discussed this topic with bringing together people from the government, people from practice, people from academia, people from the US and Europe. And actually we demystified a bit the fact that DSTs are not necessarily a response to this trade and fight against the US multinationals, but indeed it's an idea that is rooted on the rationale of saying, okay, there is value being created by the monetization of data that is extracted from users doing certain contributions to the services of certain businesses like advertisement or data collection that justifies the fact that jurisdiction may capture part of this revenue in the market. So when you think about the tax from that rationale, the discussion on DSTs changes significantly because it detaches a bit from the political context and it becomes more technical and actually more sustainable. And you see some experiences of many countries that are having good experiences with DSTs. And as I said, the latest developments have made of this topic something that is becoming a concern for all stakeholders, basically.
So pick up on one of the things that was discussed was this tariff retaliation potential. And, as we're seeing from the U.S., many changes to tariff approaches and them being used to put pressure on other countries, how does one advise clients in the tax world to prepare for potential shifts in tariff that could happen overnight?
It's a good question and a complex one. I mean, in this scenario of instability, right? I think that the US-EU agreement has provided at least certainty, which was something that was required from most EU taxpayers and companies. There is a lot of criticism on the agreement and the terms of the agreement reached, on whether 15% was enough or not, or whether the EU actually was too permissive or too generous in the agreement and in detriment of its own position vis-a-vis the US. So I do see that this agreement has provided certainty for taxpayers and for advisors to know that at least there's going to be an ease in certain or a 15% cap, right, to plan on this type of tariffs being imposed. But on top of that, especially in the services sector, we see, of course, that the EU is really reliant on US suppliers, right? Because they have a surplus in that sense in the trade balance, right? In the trade scale. So I think that it's important to note that all these retaliations under either 301 or a revenge tax that may come under 899 if the side-by-side system does not work, or if countries continue adopting digital services taxes, then it becomes very difficult, because things can really change from one day to the other. And if a country comes up with a DST or a position that undermines or it's deemed by the US president as being discriminatory, then you could increase your costs on tariffs like significantly from one day to the other. So I think that it's very difficult. We are a very difficult time. Something that I want to highlight also is that it's a bit, when you look to the discussion, it's a bit inconsistent from my perspective what's happening, because the US somehow is trying to fight many of the EU measures, labeling them as discriminatory, but the tariffs being imposed also at will on certain countries, on certain products, are a clear discriminatory also measure. So if we are going to use the same argument, I think it should apply both sides, right? And from my perspective, these geopolitical tensions and tariff tensions do not help to, in the end, taxpayers and to countries and to governments to actually provide a peaceful and certain landscape in which business can be done easily and with certainty, and that governments can collect revenue that it is generated by genuine economic activities that also improve the public services. So in the end, I think that all stakeholders in this scenario of uncertainty, confrontation, and lack of stability are affected in the end.
So turning from the sort of practical nuts and bolts of present day, I want to ask you maybe a little bit speculative here about the future, because tax is always sort of following changes that are happening in the larger economy. So the big thing going on around the world right now is AI. Do you see AI becoming a new challenge in the tax world?
Indeed. I think we are so distracted sometimes with trying to adapt the tax system to what is called the Web 2.0, right? The world of the digital economy, of business being able to operate around the world without physical presence. We're still struggling to deal with that. And in the meantime, the Web 3.0, where you have blockchain technologies, decentralization, and now the boom of artificial intelligence, it's getting us. I mean, we are there, and in the early days, we could see that at least in the tax landscape, artificial intelligence was approached more as a tool to be used by tax administration. Okay, how can you make the administration of the tax system more efficient with these automation tools, right? Then we saw a second moment in which many of the applications of artificial intelligence and algorithms to tax administration and basically to risk the detection and audits started showing their unintended side effects and negative effects when, for example, there is this infamous Dutch childcare scandal where there's been basically a discrimination and a black box algorithm being used for the purpose of assessing some certain social welfare benefits being received by certain people. And that has already sounded the alarms of some risks of using AI for tax administration purposes in terms of risk detection. So then we had if you would talk about this topic already in the early 2020s and even up to 2022, 2023, the most of the discussion on AI was on avoiding black box type of algorithms, of having a human in the loop, about explainability, about all like kind of in the tax world, the requirements that AI should comply with to be able to be respectful of taxpayers' rights. But now in the last few months, with all this proliferation of tools on AI that are showing that it's not only useful for tax authorities and for risk assessment, but also for practice, for practitioners, for citizens, in prompting and requesting AI bots to come up with efficient and fast solutions to many tax problems, ranging from legal research to drafting documents that would demand hours before. All these developments have made AI now in the last few months and I would say year being more focused on, okay, how do we use as tax practitioners this tool that is changing our life and our society to reshape the way in which we operate and we work as tax advisors and academics and policymakers. And I do see now the big tendency of exploring more the possibilities that AI provides in this regard. So many big law firms are considering pilot AI tools to check them, to test them, to somehow reconsider and adapt for what is coming. And the same in academia. We see like the whole idea of people not relying on AI to write a master thesis, a PhD, and it's being reconsidered. Like I'm thankful that I finished my PhD before the emergence of AI, because I think it's not clear yet on how much these tools will change our careers, our professions, our daily work as tax scholars, as tax practitioners, as government officials. I see now that at least there is more consciousness on that, there is more thought being poured on that, and still there are so many angles from AI that we have not explored yet. I mean, building tax rules that are embedded into algorithms and apply automatically, because we're still discussing the taxation of data under DSTs being collected by digital business to monetize them. But now that the monetization is via also these AI bots, like how is that impacting the future of the tax system? Like how is the tax mix going to look like when we see that we see social contributions from employment shrinking because AI it's taking over many positions? And are we going to tax capital? Are we going to continue taxing jobs and labor? So I think there are so many discussion and angles, apart from how do we use this practically every day to learn to prompt. Like, do we have, maybe in the future we need tax courses on how to prompt for taxation, because of course this is a very specific and technical area, and it's not the same than prompting for other purposes. So I think we live in really interesting times with AI coming up, and for me, I'm excited about it at least.
Well, it's going to be a fascinating area to watch as it develops. Juan Manuel, this has been a great discussion. Thank you so much for being here.
Thank you for having me. It's been a great pleasure, and looking forward for the next chat.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at TaxNotes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk. Tax Analysts, Inc. does not provide tax advice or tax preparation services. Nothing in the podcast constitutes legal, accounting, or tax advice. A full disclaimer is included in the transcript.